Hey everybody, welcome to Mortgage Today for Friday, September 9th, 2023. And oh, what a day it was. MBS were up 9 basis points after the first hour of trading. The government would like to see more small loans to increase access to housing, but the cost barrier issue is a major problem. It would follow then that originators that do the biggest loans make the most money. It turns out that that's not always the case. In strong markets like 2021, that is true. However, in weak markets like 2022, the originators that make the smallest loans perform the best, albeit still losing money. The broader market seemed to be in a battle over how much the labor market is weakening or not. An interesting barometer of that is the negotiation between the United Auto Workers and automakers. The bid-ask spread is pretty wide on that one, and it will be interesting to see which side prevails. GM is offering a 16% increase in wages over the life of the contract, of which will be hourly increases and some will be lump sum payments. The union wants a 40% increase in hourly rate, 40% increase in hourly pay, a 32-hour work week, a return to defined benefit pensions, an elimination of compensation tiers, and a return to annual cost of living adjustments. Unions' demands would increase the cost of each worker to $150 per hour. Whew, that's going to hurt the price of cars. There goes some more inflation. The current contract expires on September 14th. If the union gets most of what it wants, that will be a tell that the rising labor costs aren't going anywhere, and it will be justification for a longer period of higher rates. If we have a strike, it will dampen economic growth going into the end of the year, depending on how long the strike lasts. Also note that Las Vegas hospitality workers will vote on a strike on September 26th. Since the labor market for food and hospitality workers is pretty tight, this will be another one to watch. Another data, according to Curinos, August 2023 funded mortgage volume decreased 26% year over year and increased 8% month over month. In the retail channel, funded volume was down 31% year over year and up 8% month over month. The average 30-year conforming retail funded rate in August was 6.82%, which seems low to me. 13 basis points higher than July and 124 basis points higher than the same month last year. Curino drills into the data further in their report. Apart from the fact that the 10-year Treasury yields are about 25 basis points higher than they were before last Friday's jobs report, it was an uneventful week in the bond market with only one or two exceptions. The first exception was the exceptionally large amount of corporate bonds that hit the market in the first half of the week. The result was fairly constant upward pressure on rates for no other apparent reason. The second was Wednesday's ISM services data, which added to the upward pressure. Thursday marked a technical correction recovery, and the Friday ended up being entirely superfluous. Thoughts are already turning to next week's CPI, which occurs 1 week before the fairly important Fed meeting. Volatility potential would be high anyway, but doubly so in the case as the Fed is in its blackout period ahead of the meeting, thus allowing the market's imagination to run wilder than normal. MBS ended the day up 5 basis points at 98.28. So 98.28, which is just right above that 25-day moving average. We broke convincingly higher than that before the market settled down right at that 25-day moving average. So we have kind of a narrowing range because we've gotten enough data to add another technical S1 indicator at 98.086. And some other stats I saw today is word has it that owners are staying in their homes for 13 years, according to one study, although another source says 16 years. Whereas tenants stay in their rental about 3 years for a house and 2.5 years for multifamily or apartments. Also got a post from our sponsor at wellthatmakesense.com, which is all about messages, concepts, and value propositions. Most people don't put much thought into the message they are trying to communicate. They just talk assuming the audience will figure it out. It's good to take some time and think about your value proposition, how you're different, and why somebody should talk to you or be influenced by you. Looking into next week, we got quite a bit of data. So it starts up on Tuesday. We have a 10-year note auction, which will kind of gauge the market. On Wednesday, we get the core CPI, headline CPI, and also a 30-year bond auction. So that should be a very volatile day because that is going to give a big indicator of what the market thinks the Fed's going to do, which will be reacted upon when we get jobless claims on Thursday, as well as producer prices and retail sales. And then on Friday, we get consumer sentiment, which might bounce it around a little bit depending on how volatile those previous days are. So all that stuff is out of our control, but what is under our control is our own brain. So check out some knowledge this weekend at our core influences, especially our sponsor at thatmakesense.com.